founded Global Resource Investments, Inc., which provides investment advice and brokerage service to high net worth individual investors, institutional investors, and corporate entities worldwide. Global Resource Investments, Inc. is now part of the Sprott Inc. group of companies. Mr. Rule has been active in natural resource investing for 35 years and is a well-recognized analyst in mining, energy, water, forest products, infrastructure, and agricultural sectors. Rick, thank you so much for joining us today.
Always a pleasure. Thank you very much for having me on.
Absolutely. Stage is yours.
I'd like to begin this, as I often do, by thanking the people at the Money Show. Putting on a conference like this is a really amazing amount of work. So on behalf of all of your attendees and all of your exhibitors, thank you for the hard work and wonderful work that you've done over the years, both in live shows and, of course, this video show. And please pass on my compliments to all of your colleagues.
Absolutely. Thank you.
There are going to be 3 or perhaps 4 parts to this talk today. The title, as you suggest, is Two Bull Markets. I believe, for reasons that I will explain in the course of the talk, that we are in the earlier stages of a precious metals bull market, and this will be followed later on in this decade by a very interesting, more broadly based natural resource market. When I say 3 parts, there will be an overview where I describe natural resource and precious metals markets in a very general sense. A second part where I describe the precious metals bull market that I think that we're in. The third part where I talk about the more broadly based natural resource markets and its anatomy. And if time allows, or rather if I'm not too long-winded, we'll have a question and answer session at the end. I would like to note that I will make use throughout this lecture of 2 charts, the Barron's Gold Mining Index chart and a much broader commodities chart going back 100 years. I will give you information at the end of the talk about where you can obtain these 2 charts from me for free. They're wonderful educational tools. I'm not referring to them in the context of technical analysis at all, but rather as a visual aid to make the market-related points that I intend to make during the talk. So let's get started with an overview. One thing I've learned in 45 years in the natural resources businesses is that they are capital intensive, they are cyclical, and they are volatile. Those of you who have heard me speak at Money Show events earlier have probably heard my slogan. In natural resources, you are either a contrarian or you are going to be a victim. That's because these are capital intensive cyclical businesses. In fact, the boom town and the ghost town are really metaphors for the natural resource business. We have great times and we have horrible times. What's interesting, of course, is that the horrible times, like the times that we went through in the period 2011 to 2019, are in fact necessary in order to enjoy the good times. And the good times necessarily result in bad times. That's the nature of capital intensive businesses. We have been through a bear market that was really, truly one for the record books in natural resources. The small cap natural resource index, the biggest of them, the Toronto Stock Exchange Venture Resource Index, fell a stunning 88% in nominal terms between 2011 and 2019. And if you follow that the cure for low prices is low prices, that in fact worked its magic. The sector became so cheap that without even a rebound in commodities, prices had headed up simply because the commodities were oversold. But the basic materials prices have begun to add too. As I say, I'll be referring to the Barron's Gold Mining Index graph, which I'm happy to send, and also to a broader based commodity one. But I think it's just necessary to understand that bull markets, like the ones that we're headed into, are caused by bear markets. And this bull market, when it runs its course, will be the cause of the next bear market. If you understand that, you understand a lot of what you need to know about investing in natural resources and precious metals. Now, I believe that we're in a precious metals equities bull market. I think the price action that you have seen in the last year is indicative of that. The Barron's Gold Mining Index shows 2 different types of positive reactions for precious metals equities. One is the classic bull market, and the chart shows very clearly a bull market that began in 1970 and probably peaked in 1981, and a separate and distinct bull market that began around the year 2000, and depending on how you graph it, either ended in 2008 or 2011. And these were truly epic events, with the equities indexes gaining well in excess of 1,000%. The chart also shows 8 recoveries from oversold bottoms in both bull market and bear market conditions. These are much shorter events, punctuations, if you will, in bull markets and bear markets. But it's interesting to note the volatility in precious metals equities, which is different, in fact, than their cyclicality. And in these recoveries from oversold bottoms, the durations were as short as 9 months and as long as 40 months. And the gain from top to bottom varied between 140% on the upside. By the way, this is an index upside, not the best stock in the index, and almost 800% to the upside. So these markets are both cyclical and volatile. As I said at the top of this discussion, I believe that we are at the beginnings of a gold bull market, not merely a cyclical recovery from an oversold bottom, but rather a secular gold and precious metals equities bull market. And I'll give you 4 reasons why I believe that's true, all of which, at least the first 3, relate to gold, and the last relates to both gold and precious metals equities. I truly believe that the wind is in the sails of the commodity. When people say, Rick, have I missed the gold market? It's moved from 1,100 to 2,000. I like to point out that in the 2 gold bull markets that I've lived in my career, the first one, of course, the epic one in the 1970s, the gold price moved from $35 to $850 an ounce. Now, I'm not suggesting that gold is going to go up in price 25-fold this time. But the second gold bull market, which was tame in relation to the first, beginning in the year 2000 and ending perhaps in 2011, also saw the gold price go up rather dramatically, from $250 an ounce to a high of $1,900 an ounce. How high will gold go this time? I don't know. I'll leave that to your imagination and your own studies. But I want to give you several reasons why I think that the run in gold is really, truly just getting started. And I want to preface it by saying, at least in my life, gold has moved for many reasons related to fear. But the most important reason that gold has moved in my lifetime has been people's fear of the ongoing purchasing power of their savings in more conventional instruments, particularly instruments denominated in the world's reserve currency, which is to say the US dollar. And more particularly, their fear of the bellwether security worldwide, which is the US 10-year Treasury, which is regarded as the benchmark security against which all others are valued. It is my belief that investors and savers fear worldwide about the preservation of purchasing power in US Treasury securities, particularly the US 10-year Treasury, is the reason why gold is moving. And I believe that those fears are well-founded for several reasons. The first, of course, is quantitative easing. If anybody here on the phone, if you or I engaged in quantitative easing, it would be called counterfeiting, and we would be put in jail. In fact, what quantitative easing is the creation, in effect, of false currency units or false credits, credits unbacked by anything, not tied to anything. Truly, if you think of quantitative easing correctly, you think of it as counterfeiting. It isn't illegal, I guess, because it's proscribed by law. They do it, we don't do it. But it has the same impact. It has the net effect of ultimately, over time, debasing the currency and debasing confidence in the currency, which may be the same thing. The second reason why I believe people's fears are justified are fiscal, debt and deficits. It is astonishing to me that the on-balance sheet liabilities of the US government exceed $24 trillion. What's more worrying, perhaps, is the off-balance sheet liabilities, which is to say the promise to pay that the American government has made on behalf of its people. Things like Medicare, Medicaid, Social Security, the Environmental Trust Fund. Those liabilities, according to the Congressional Budget Office, exceed $100 trillion. So as a people, Americans owe each other $120 trillion. By the way, that number doesn't address unfunded pension liabilities, nor does it address state and local debt. These debt numbers are astronomical. It would be okay, I guess, if there was a way to service them. But the problem with that, of course, is that we service those debts with the national income, which is to say taxes and fees less expenses. The problem with that is that the national income is in deficit. In the month of July alone, the federal deficit, the United States federal deficit, exceeded $850 billion. In other words, our government lost almost $1 trillion in 1 month. And those deficits look likely to continue for a very long time. Now, one must ask oneself in terms of juxtaposing the treasuries against gold, how is it that you add a column of negative numbers, which is to say the deficits, and come up with a positive sum? Because it's a positive sum that's necessary to service that debt. I think the answer fairly obviously is that the debt isn't going to be retired and it isn't even going to be serviced, that we will rely on quantitative easing, which is to say counterfeiting, to pretend to service and retire these debts, which will be rescheduled over time. Not a comforting thought for a bondholder. The third reason why people's lack of faith in the purchasing power of their savings denominated in US government securities is simply artificially low interest rates. Negative interest rates. As Warren Buffett says, negative interest rates are not a force of nature. They're a construct of man. They're a function of confidence, overblown confidence from my point of view. In democratic terms, and I'm not talking Democratic versus Republican, but merely in political terms, what artificially low interest rates are actually is a manifestation of a war against savers by spenders. Spenders, being more numerous than savers, of course, favor that. In a democracy, it's not unusual to have a successful war on savers by spenders. Interest rates represent a couple things. They represent the premium that savers might enjoy from postponing consumption, not spending the money now, but rather lending it to other people to spend in hopes of generating a positive return so that their ability to spend more, consume more in subsequent years is higher. But interest rates also reflect a risk premium. They reflect compensation for taking credit risk. And the whole idea that you would at once forego consumption at the same time that you decided to forego a premium, a risk premium for credit, particularly when the borrower is $120 trillion upside down, beggars description. My good friend Jim Grant has described negative interest rates as, quote, return-free risk. And I would argue with you that gold's principal competition right now for investors' favor is, quote, return-free risk. Not a hard fight to win. Now, there's a fourth reason, too, why I suspect that precious metals and precious metals-related investments will do well in the next 4 or 5 years. And that's simply because they are under-owned. A study completed about 1.5 years ago suggested that the market share of precious metals and precious metals-related assets in the United States, I don't have similar figures for the world, but in the United States was between 1/3 of 1% and 1/2 of 1%. What that means is that the sum total of Americans' investments in precious metals and precious metals-related equities comprised less than 1/2 of 1% of their total savings and investment portfolios. Way, way under-owned. The same study estimated that the 3-decade mean market share for precious metals and precious metals-related assets in the United States was between 1.5% and 2% of total savings and investment assets. So I'm not arguing with you in any way, shape, or form that precious metals or precious metals-related assets have to dominate the US dollar, that there has to be a return to a gold standard. I'm only suggesting that if the market share of precious metals and precious metals-related assets returned to the 3-decade mean, that would mean demand for this asset class would go up somewhere between 300% and 400%. That's precisely what I think is going to happen. And I think precisely because of that, the flow of funds into this asset class will cause them to go higher than most people believe they will at this point in time. It's important to understand in a historical context, too, the anatomy of a precious metals market. In the markets that I have lived through, the metal has always moved first. The metal moves because of fear. The gold buyer is a fear buyer, either a generalist or not a generalist, a gold bug. But gold gets bought before the precious metals stocks get bought. The increase in gold price, which is to say the increase of the selling price of the product produced by gold mining companies, rises faster than the costs associated with producing it. So the company's margins increase. And as the increase in the gold price is reflected first in the income statement and then later in the balance sheet of the producing companies, they begin to move, but for different reasons. They move because they're cheap relative to their free cash flow. And we have indeed seen that this year, 2020, and a bit in 2019. In typical gold bull markets, the biggest and the best of the best move first. The gold bugs move into those early on because although they believe in the thesis, they're tired of getting spanked in the more riskier investments. And when the generalist money comes in, the generalist money, at least initially, aware of their lack of knowledge of the sector, move into the most liquid names, the best of the best. And then the money traditionally has fallen down the quality trail, which is to say, you go to progressively smaller, progressively more illiquid, progressively riskier investments. That's the nature of the market. It's also true in terms of the metals that gold moves before silver. I know many of the silver bugs at the beginning of this year were beginning to be restless. Gold had moved, but silver didn't move. Why was that? Because gold always moves before silver moves. But traditionally, silver, although it moves later, moves faster and it moves further. And my suspicion is that in this market, that past will be this prologue. In other words, silver will lag gold for a while, and then, at least for speculative accounts, the silver will outpace gold. The silver equities, too, generally move after the gold equities. The narrative becomes the strongest when the momentum has already been established by gold. If this market behaves like prior markets do, the stocks that will generate the most alpha to the market will be those few high-quality silver stocks. Why? Because there are so few of them. The market cap associated with silver stocks is so small relative to the amount of money that tries to crowd into them when the narrative is strong, that their upside momentum becomes, frankly, excessive. Pleasant, but excessive. So I hope I've made the case that we are in the beginnings of a gold bull market, and we're in the beginnings of a gold bull market for rational reasons. I hope, too, I've made the case that the gold and precious metals bull market will continue because the wind is in gold sails, but also because precious metals and precious metals related equities are under-owned. Their market share in a historic sense is very small. Let's move on to industrial materials, which I think is fascinating. The industrial materials market, even as we speak, is pretty healthy, healthier than I had expected it to be. In particular, the iron ore price, the coal price, and the copper price are substantially stronger than I expected them to be. And it wouldn't surprise me to see them decline before they go up. Why is that? Well, my suspicion, and I'm not an economist, I'm a credit analyst, but my suspicion is that the broader economy, the world economy and the US economy needs to do some unwinding. I believe this because we experienced an amazing economic recovery in the United States in the period 2009 to 2019. My belief is that a lot of that recovery was artificial. It was due to quantitative easing. It was due to low interest rates. It wasn't due to increases in productivity. It wasn't due to increases in world trade. It wasn't due to increases in individual wealth. Rather, a lot of the economic growth that we experienced was bought, to be sure, but not paid for. I believe, too, that there's a broad disparity between the fortunes of Wall Street, which is to say debt and equity markets, and the fortune of Main Street, which is to say the broad economy. And any time in my life before when there has been this broad of a gap between the performance of financial markets and the performance of the economy, unfortunately, that gap has been filled the wrong way. So my belief is that the world economy will continue soft for 3 or 4 years, particularly while we digest the impact of the COVID-19 virus on national economies, but also on world trade. And industrial materials, broad commodities, are very much the stuff of the economy in general. It takes demand, it takes a healthy economy for the demand side in industrial materials and broad commodities to increase, which I do not see. My own suspicion is that the economy is soft for 3 or 4 years and industrial materials are soft for 3 or 4 years. But remember, low prices are the cure for low prices, and the continuation of weak commodity prices means that the companies that produce these commodities will have neither the will or the means, the cash, to continue to make investments in supplies for the future. Remember that every day you mine a mine, your business gets smaller. Eventually you deplete the ore body. You can't throw fertilizer and water into a hole in the ground and have that hole in the ground grow more copper or coal. And the failure to make sustaining capital investments and new project investors means necessarily that you are constraining future supply. And it's my belief that as a society, we have already underinvested in the commodities complex for 10 years. If you continue to underinvest, what you do is you impair for a very long time the industry's ability to meet increased demand with increased supplies. And when you tighten the supply-demand imbalance with supply destruction rather than demand increases, what happens is that when the prices begin to move up, the industry can't produce more material to meet that increased price signal. It takes 5 years or 6 years or 10 years or 15 years or 20 years to permit, to finance, and to build a mine. That's a very, very, very long time for unmet demand to increase. So the anatomy of a bull market in materials is very much that an extended period of low prices causes shortages to appear. And the industry's inability to address those shortages because of the capital-intensive cyclical nature of the industry means that the price recoveries are much more dramatic and last for a much longer period of time than we would suspect. If you will remember back to the amazing commodities bull market that many people on this call would have enjoyed in the period 2000 to 2008, we had precisely this circumstance. The decade of the 80s and the decade of the 90s saw broad societal underinvestment in natural resources and commodities businesses, partly working off the excesses of the decade of the 70s. But the impact of 20 years of malinvestment and underinvestment meant that as emerging and frontier markets, particularly China, began to increase demand, the industry couldn't increase supply because of the lag times that required. And that decade, 2000 to 2010, if you will, saw very, very, very broad and very dramatic gains in commodity prices. I might remind people that in 2000, the price of oil was $18 a barrel. I think it peaked at 145 or 150. The price of natural gas hovered around $1 per million BTUs and peaked around $15 per million BTUs. Similarly, the copper price rebounded from 75 or 80 cents to a high of $4.50. And I could go on and on and on. The star, of course, being uranium from $8 a pound to $150 a pound. Past in this case, I believe is prologue. I don't think that you'll see this broad-based recovery in a year or 2 years, or probably even 3 years. But my belief is that sometime out there, 3 years, 4 years, 5 years from now, you will begin to see a bull market, first in commodities pricing, and then in the prices of the companies that produce these commodities, that will resemble the bull market that we enjoyed so much in the 2000 to 2006 period. So my belief is, and in fact my investment activities will be geared to the belief that natural resource and precious metals investors are going to enjoy 2 bull markets. A gold bull market that, although it's been handsome thus far, is really just getting started. If you will, we're in the 3rd inning of a ball game that likely goes extra innings. I believe that this gold bull market will be succeeded by a broader-based natural resource market that won't be driven so much by inflation, the 1970s markets, as it will be driven by supply destruction. And I hope the people on this call will keep their heads about them, but be aggressive and participate in these markets, because I'm not sure, I don't know, but my suspicion is that some other markets will be much less generous than ours. I'd like the ability to communicate with all of you, and so I'd like to make an offer in the brief time I have left. That offer is this: if you will request of me at a web address that I'm going to give you in a moment, I will send you the Barron's Gold Mining Index chart, which will show you precisely where we are in this market relative to the other markets that have happened for the last 50 years in precious metals and precious metals related investments. In addition, I will send you a 100-year commodity chart showing you just how cheap commodities are relative to asset classes when you look back over 100 years. A truly, truly startling chart. But I'll do something else that's much more personal. I will rank your natural resource portfolios personally, 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think my comments might be relevant. You can access this offering by going to SprotUSA.com/rankings. SprotUSA.com/rankings. You'll find a web form to enter in your natural resource portfolio. And if you ask for the charts, I will happily send them. This is an absolutely no obligation offer. I look forward to doing this. It's the most honest and finest form of communication and marketing that Sprott can do. In summary, thanks once again to the Money Show people, and thanks all of you to listening. If I do have any time left, I'm willing to entertain any questions that you might have, Mr. Host.
Rick, thank you so much. Excellent presentation as always. Let's do a few questions here. Do you think we are in the midst of a mild correction in the current bull market, or do you think we're still in a secular bull?
I think we're very much still in a secular bull market. I'm delighted that the listener asked that question, because when you examine the Barron's Gold Mining Index chart, what you see is that there can be cyclical declines in a secular bull market that really take your breath away. These markets can decline by 15 or 20 or 25%, but with as much ease as you and I inhale and exhale. So absolutely look at the chart and understand the cyclicality. You can have, as I say, cyclical declines in secular bull markets that are really, truly unnerving.
Mm-hmm. Absolutely, thank you. Our next question: if an effective COVID-19 vaccine becomes available, a huge risk on appetite for S&P stocks may appear and cause a massive reallocation of investment funds from precious metals and PM mining stocks to S&P or Russell 2000 stocks. What are your thoughts about the risk facing those of us who are long physical PMs and PM equities?
Well, I would encourage people not to be 100% long in any category. I think precious metals and natural resource equities deserve a place in the portfolio. I don't think they should be a whole portfolio. My own belief is that the gold price goes higher irrespective of a cure or a lack of cure for COVID, because I don't see a cure for government. My own belief is that the pressures on the US dollar and on US treasuries and on the US Treasury itself will continue. And as a consequence of that, the gold price will go higher. And a higher gold price, make no mistake, will benefit precious metals companies. It is true that there will be occasional disintermediation of the precious metals complex into other sectors of the economy. But my suspicion is that precious metals and precious metals related assets for the next 3 to 5 years will do very well, well in comparison to other sectors, but more importantly, well, absolutely.
Thank you. Let's see here. Do you think royalty companies will outperform mining companies over this life of this current bull market?
I don't believe that royalty companies will outperform over the life of the market, but I believe that they'll outperform for the next 2 or 3 years. The royalty and streaming company is a superior form of business in the sense that they're much less capital intensive and their operating costs are lower, which is to say that their margins are higher. What happens towards the end of a gold bull market is that the much more marginal companies actually do best. Rapidly increasing gold prices increase the free cash flow of the marginal producer, the high cost producer, more than they do the established producer. In my own portfolio and in my clients' portfolios, despite the fact that the lower quality companies will ultimately outperform the higher quality companies, I myself will maintain a large portion of my assets in the royalty and streaming companies, being willing to underperform the index if necessary in order to de-risk the index.
Excellent. Do you have any view on uranium going forward?
I'm a real uranium bull, but not in the near term. One thing mitigates against uranium, which is to say a slow economy worldwide and lower demand for Japanese export materials, which constrains the pace of Japanese restarts. Longer term, the utility associated with uranium is tremendous. We are selling uranium for less than it cost us to produce it, but it's an essential part of the energy mix, including in rich countries like the United States. In the United States, uranium accounts for about, if my memory serves me well, 20% of baseload demand and 15% of total power produced, which is to say that irrespective of alternatives and irrespective of many people's preference for alternatives, there aren't any in the near term. If the uranium price doesn't go up, the lights will go out. It's as simple as that. And my belief is that the uranium price will go up, and the lights won't go out. I'm not suggesting that this will happen within 12 months or 18 months or 24 months. I don't know when it will happen, but I do know that it will happen.
Excellent. Rick, do you have time for a few more questions?
I have time for two more.
Excellent. Okay. What sector of the precious metals, sector, i.e. producers, developers, streamers, do you believe is the most undervalued and why?
I think the middle part of the market, frankly, is the most undervalued. What's happened, interestingly, is that the best of the best have moved well. And for the first time in my life, the micro caps have moved almost concurrently. There's a narrative-oriented market occurring at the bottom and a quality-oriented market occurring at the top. The most undervalued part right now is the middle, the people that will be subject to M&A, particularly the single asset producers. Multiple asset producers are regarded as less risky, so they trade at higher multiples. When a multiple asset company acquires a single asset company, the single asset discount immediately goes away so that the acquisition can be accretive to both buyer and seller. And I think that's what's going to happen. For sophisticated precious metals investors, and I suspect that there are some on this call, the way you really truly play the game is to work very, very hard and participate in private placement markets. But this isn't something that's for the faint of heart. So I would suggest that the answer to that question really depends as much on who the investor is, how much risk that they're willing to endure, and the time frame that they have involved. In other words, it has as much to do with the individual as it does to do with the sector itself.
Excellent. All right, our final question. Do you have a price target on gold or silver that you would be willing to share?
I do not. I really do not. There are so many factors. Remember that the gold price is denominated, at least for those of us in the United States, in US dollars. And the US dollar is, in a sense, a floating abstraction. So it's difficult to understand what the value of the dollar will be 5 years from now. Hence, trying to establish a gold price in a medium of exchange that is in and of itself a floating abstraction is very difficult. I know your audience wants that, but at 67, I'm too old and too wise.
Well, Rick, we really appreciate you today. Thank you so much for joining us. We went ahead and put the link that you mentioned there, sprottusa.com /rankings. We really appreciate all your time and all your wisdom you share with us every year, and we hope you stay safe. And thanks again for joining us.
Well, thanks to your audience and thanks to you, the Money Show staff, for, as always, putting on a great show.
Absolutely. As a friendly reminder, be sure to join us for day 2 of the Money Metals and Mining Virtual Expo, kicking off tomorrow morning at 10:20 a.m. with an opening keynote from Peter Schiff, Chief Economist and Global Strategist at Euro Pacific Capital. You have the opportunity to watch and listen to dozens of additional presentations throughout the day from experts who will share timely strategies for holding precious metals for wealth insurance, as well as their best ideas for cashing in on the bullish momentum. And last but not least, be sure to tune in on day 3 of the Money Metals and Mining Virtual Expo this Thursday for another chance to watch Rick Rule live. He'll be joined by Adrian Day of Adrian Day Asset Management, Brian London of the Gold Newsletter, and Peter Schiff from the Euro Pacific Capital for a closing panel on what the trends in money, metals, and mining means for your portfolio. Thank you everyone for joining us today, and we hope to see you tomorrow. Thanks, Rick.